NUSI, the Nationwide Risk Managed Income ETF, is an ETF that targets a high amount of current income with very little risk. It currently has an 8% dividend yield and pays out dividends monthly. So does it deserve a spot in your portfolio? Let's find out. How's it going, everybody? Welcome back to the channel. My name is Jay, and today we're talking about the Nationwide Risk Managed Income ETF, ticker symbol NUSI. We'll go over all the details of the NUSI ETF, how it works, what it holds, how it pays that 8% dividend yield, how it stacks up against QYLD, which is a very similar ETF to NUSI, and finally, whether or not NUSI is worth buying and worth investing in for your portfolio. Before we get into all that good stuff, I just have to ask you to please hit the like button down below on this video. It really helps me, the video, and the channel out, spreads us around to new people who might not otherwise see my beautiful face. So with that out of the way, let's get right into it. What is NUSI and how does it work? NUSI is an income ETF from Nationwide, which most of you may know as just an insurance company. But the name of the ETF is the Nationwide Risk Managed Income ETF. So I guess that whole managing risk thing falls right into their wheelhouse as an insurance provider. NUSI, however, has nothing to do with insurance products whatsoever, so don't worry about that. It does offer a near 8% dividend yield and pays out those dividends on a monthly basis. And the overall strategic goal of the ETF is to offer a high amount of current income while managing the risk you take on to do so. And if you go to the NUSI fund prospectus, they say right off the bat that the constant decline in interest rates since the 1980s has made it increasingly more difficult for investors to find reliable streams of income from traditional bond investing sources. So they created the NUSI ETF to kind of fill this gap of being able to generate income from your investments where you would traditionally look towards bonds, but with interest rates being at historical lows, you're not exactly getting from that source anymore. So how does Nationwide plan to accomplish this with the NUSI ETF? How does it work, and what are its holdings? So we can break down how NUSI works into 4 steps. Step number 1 is they buy and hold all of the stocks that make up the NASDAQ 100 index. Step number 2 is they implement what they call a protective collar strategy. No, not like that. Protective collar strategy is an options trading strategy that lets you play both sides of the coin in a way. On the upside, you're selling covered calls against the stocks you hold to collect income and set a limit where you'll sell the stocks should the price rise. And then on the other side, you're buying a put option, so if the price of your stocks falls, you can also sell at that price on the bottom end. So you can kind of think of it like a sandwich, where you have your stock that may be trading at $100 right now, so you're selling your covered call at maybe $110 per share, and then you're buying that put at maybe $90 per share. So you're well protected within a range whichever direction that stock moves. And because NUSI is selling the call options and buying the put options out of the money, it leaves room for price appreciation on the upside and still limits your downside by locking in that floor amount with the put. Step number 3 in the strategy of NUSI is to collect the premiums from selling those call options and any dividend payments on those 100 stocks it holds, and distribute that back to you and me as the investors in the form of that monthly dividend. And finally, last but not least, step 4 is any leftover premium after all that is done, they take and they reinvest back in those NASDAQ 100 stocks. Now, if you're a regular on my channel, you may remember a video not so long ago where we looked at the QYLD ETF. And right now you're probably saying to yourself, Jay, this sounds a lot like QYLD. What's the difference? And I'll tell you what the difference is. QYLD is also an ETF that buys the NASDAQ 100 stocks and sells covered calls against that index for the income it provides. The main difference is QYLD is selling the covered calls at the money. And what at the money means in options terms is when you have a stock trading at $100 and you sell your call option, the strike price of that option is also $100. NUSI, on the other hand, is selling the call options out of the money. So again, if we have a stock that's trading at $100, selling an out of the money call option may mean we set the strike price at $105 or $110. Doing this will generate a little less income from the options premiums when we're selling that contract, but it leaves us room for price appreciation on the range between where that stock is today and wherever we sell that option the strike price at. And another main difference between QYLD and NUSI, so where QYLD isn't limiting the downside risk whatsoever, NUSI is buying that put option and kind of setting the floor. So if our $100 stock drops to $90, we sell our shares and collect the income right there. So that's the main difference between QYLD and NUSI. QYLD is generating more income by selling at-the-money options, but QYLD doesn't leave room for capital appreciation, and it doesn't limit the risk on the downside should the NASDAQ 100 start to tank. NUSI generates a small amount less premium, but does give room for capital appreciation and does limit the risk on the bottom end. Now, how will NUSI perform, and how will it perform versus QYLD in different market scenarios? And let's start with a rising market, a bull market. Now, it's important to note right off the bat that in a rising market, all of these income ETFs we'll look at will generally underperform the broader index. So NUSI, QYLD are going to lag QQQ, which is the NASDAQ 100 index ETF, by a large margin in a rising market. In a slightly rising market, a slowly rising market, NUSI will perform pretty well. It'll be collecting the premiums from the call options contracts, and you'll be gaining the share price growth in between where the index started and wherever it finishes at the date of expiration of those contracts. So in a slowly rising market, NUSI will outperform QYLD mainly due to the capital appreciation between where both ETFs sell their call options at. Next, let's look at a sideways or a stagnant market, or even a market that drops just a little bit. In this kind of market, it's all going to come down to the premium being generated from those options contracts. Because the market isn't rising and hitting those strike prices for the options contracts, you're not selling off your underlying stocks. So really all these ETFs are doing in this scenario is collecting those premiums and distributing back to the investors. In this scenario, QYLD is going to outperform NUSI because QYLD is selling those at-the-money options contracts which collect a higher initial premium. Now, in a major market crash, NUSI is going to outperform QYLD. Because remember, NUSI buys those protective puts on the downside, so there's a floor to how far it can fall before those are exercised. So with QYLD, if we start at $100 and we fall down to $50, you're taking on all of that downside risk. But with NUSI, if the index starts at 100, they're buying those puts at, for example, 90. So as the market falls, NUSI is selling and collecting the money at $90. So if it continues to fall further down to 50, you're not taking on any of that risk between $90 and $50 or wherever it may end up. And we can see this in action if we take a look at this graph here of the two ETFs, QYLD versus NUSI. Look at how they performed in March of 2020 when everyone thought the world may be ending. QYLD dropped much farther and much harsher than NUSI did at that point. And here we can also see since its inception, it has outperformed QYLD by about 11%, including dividends. The next thing we always want to look at with any mutual funds or ETFs is what's the expense ratio like. NUSI has an expense ratio of 0.68%. This is slightly higher than QYLD, which is 0.6%, but it's still lower than most actively managed funds. If you look at a lot of the ARK funds, they are at 0.75%. So how would you use NUSI in your portfolio? Lucky for us, the fine people over at Nationwide give us this handy chart right in the NUSI marketing materials that suggest how they think you should use the ETF in your strategy. Number one, a complement to the traditional 60-40 portfolio allocation, which is 60% stocks, 40% bonds. Number 2, they say you can use it as a bond alternative to provide greater flexibility across market cycles. Use number 3 they suggest you can use it as a way to damper volatility within your existing portfolio allocation. And last but certainly not least, as a tool to provide current income from your investments, with which those monthly dividend payouts and that 8% dividend yield, I think is going to be the main draw to the ETF for a lot of people. And as you look over those 4 points in that list, a lot of those things are what bonds were traditionally used for over the years. But like we saw at the beginning, they created this ETF as kind of a replacement for bonds because interest rates are so low over the past 20, 30 plus years that you just can't generate the kind of income a lot of people are looking for from bonds alone anymore. Let me know what you think of the NUSI ETF, if you're intrigued by it all or if you're already investing in it. Leave me a comment, let me know how it's working out for you. Check out these 2 videos right over here if you're looking for other investment ideas or other videos that'll help you become a better investor and better with your money. Thank you as always for taking the time to watch this video. I hope you enjoyed it and I'll see you in the next one.